Hello, Ashish. Nope. Hello, Ashish.
Hey, Daniel, how you doing?
How's the investor life?
You tell me. You're full time. I'm just moonlighting.
It's rough out there, to be honest. It's rough. It's hard to find deals. But this week, actually, I spent the majority of my time starting the fund, and I literally 10 minutes ago got the first draft of the fund documents from my lawyer. So
Okay.
I got a weekend project now to read through them.
Are you using sidecar.io or something, or who are you using?
I'm using Wallace Glowski, who's a lawyer in Portland.
Oh,
He's I know a couple of friends who use him. He's not the most common, but he seems to have good Portland connections.
Okay.
And so far I like him.
Cool.
I know Bronson Hill and a few other people use him.
Oh, I see. Okay.
There's Mike.
I recently used formed an SPV with a company called Loon Creek Capital. They specialize in, these special purpose vehicles, right, for investments. Great. I mean,
Loon Creek Capital, are they specific a law firm, or are they the investment firm that's setting it up for you?
It's a law firm, but they specialize in setting up, just LLCs for, they specialize in pooling investor capital, and then they're not identifying the deals. They're just it's just investor services.
Right. Mike, I for a moment thought you were the speaker today, because the speaker's name is also Delaney. Spelled the same way, I believe.
Yeah, that's my son.
Oh, it is. Oh, okay, great. Good to meet you.
Thanks.
I looked at you twice and I was like, that's not him.
That's not him, right?
But it kind of looks like him.
This is what he'll look like in about 30 years.
Yeah, I'm taking on my father's features too.
There's some good genes then, Mike. Hey, John.
Hey, Ashish, how's it going?
Good, thanks. How you doing?
I'm good. Good to see you.
You too.
Hey, John. Hey, Glenn. Caden.
Friday.
Happy Friday. Happy Friday. Let's hope our speaker shows up here soon. Got the speaker's father, so I know I can get in contact with him if I need to.
Thanks for hosting.
But we usually wait till about 5 after. What was that, John?
Thanks for hosting this. I've been to about 4 or 5 of these now.
Oh, really? How'd you find the group?
Well, it's Ashish recommended.
Oh, through Ashish. Oh, wonderful.
John's my neighbor.
I know where you live then. How are things going on your side, Glenn? How many people do we have registered today on the Intel side?
Yes, the weekly poll question.
Yep. Intel doesn't give me access to their meetup site anymore now that I'm not with Intel. So gotta ask you. There he is.
How you doing?
Well, you two do look alike.
Oh yeah, who's that?
Mike Delaney and you.
Oh, there it is. Yeah, right there. So perfect.
180, Daniel.
180 people registered. That's a pretty good number. So we'll probably get half of that. Although I'm surprised we don't have more. Oh, look, my wife joined. Oh, no, wait, her audio isn't connected yet. 1 second.
Because she's tired of listening to you, Dan.
Yeah, she runs an STR, and I said that was going to be our topic today.
No.
Why isn't our audio joining? Because I can't stretch this humorous moment out any further. All right. We'll wait just a few minutes. Ah, there her audio joined. Look, my wife joined. All right. We're going to wait a few more minutes. Let's try to get it up over 40 or 50 before we get started. And first of all, hey, happy Friday, everybody. It's hot in Portland. If you're in Portland, sure, it's even hotter if you're from Folsom or from elsewhere in California. And what are you guys doing down in Arizona this time of year? I guess you're in an air-conditioned office. How is it down there, Glenn?
Well, we're about to get hit with a hurricane. So Southern California and Arizona. So we're supposed to actually drop like 20 degrees for the next couple of days. and get like hopefully our first rainfall of the year almost.
Crazy.
How severe is it supposed to be? I mean, Phoenix is inland quite a bit.
Yeah, they're saying somewhere like all the way up to like Las Vegas is potentially like flooding with a few inches of rain if it actually tracks. So it's going basically almost completely north-south in its track. So it's running right up Baja California and into Southern California and up into Nevada. So
Right.
Yeah.
Is the ground in Arizona so dried out that it has trouble absorbing water when it comes?
It does do that.
Yeah.
Whenever the rain comes, it does. It's I mean, it's a desert in general, so it's dry, cracked ground, but it does not. It's not super porous. So it takes it a bit to absorb into the table.
So which do you prefer, a hurricane or the sandstorm? What were the sandstorms called there again? They had a funny name.
Haboob or
Habooby.
no I on the end or Y on the end, just haboob.
Haboob. That's what it is.
Yeah. I don't like the sandstorms. And now that I've had valley fever once, which I don't recommend to anyone, it's like some fungus that grows in the dirt. So when the sandstorms come in, they're blowing all of the fungi around in the dirt. And that's how a lot of people actually catch it. So
That
don't go out in the
awful.
dust. Yeah, I got pneumonia with it and all kinds of other side effects. So, and the medication's horrible. So I don't recommend it to anyone.
Glad you're feeling better. All right,
Thanks.
we've got 45 people here on the line. So we're going to get started here. So really quickly, I don't really have any opens other than if you look at the alternatíveinvestingclub.com and you go to events, you can see some of our upcoming events. Next week, we're going to be talking about conserving America while reducing your adjusted gross income. Then investing in a business even an idiot can run. In this case, it's mobile home parks. Finding your edge. And then I have an interesting one, and I'm not sure how well this will work for this group or not, but I have a person who specializes in bringing in Chinese investors, and they set up what's called an EB5 investment entity. It's an investment entity that allows Chinese investors to come in and buy land. And in doing so, for every $100,000 that they put into it, the government gives them credit of stimulating 12 American jobs and apparently an expedited green card service. This is the first time I had heard about it just a couple days ago. So I thought I'd bring in somebody to talk about that as an interesting educational topic, because that's what we do in this club. We're learning about real estate in order to up our games, to learn more about what we can do, how we can strategize better and be creative in our real estate investments. One thing I would like to say here too, is that if you have enjoyed this club over the last 5 years now, we're coming up on 5, actually next month will be 5 years. If you've enjoyed this club, if you've got some benefit out of it, if you've learned something, if you've made your first investment, then there's a fee, and the fee is share the show, share the group. I just dropped the link into the chat room there. You can go there and grab the graphic for this week. It's with Kale Delaney. And I would appreciate it if you found value in this group, send a little value back, value for value. It would be great if you would share this group. And we do need to share the group just to expand it now that we're outside of Intel as well. So do us a solid and share the group on social media. And there's a great graphic at that link that you can grab and use for your post. So, and hashtag Alternative Investing Club. All right, with that, we're going to bring on our speaker here. Actually, 2 minutes. Are there any opens? Any opens in the group? Any topics that you would like to hear about in the future?
I was reading
Okay.
recently, Daniel, about the latest reports for the last 3 months with regards to apartment rental rates softening, and how that's putting pressure on buyers and sellers both in terms of valuations. I don't know that there's necessarily a topic. Maybe it's a good club chat topic or something like that, and how people are dealing with that with their various investments, if they have strategies in order to mitigate through their original business plan or something like that.
Yeah, that's a great topic actually, because we're definitely at a point in the market where there's a lot of FUD in the market, fear, uncertainty, and doubt, and that's really the enemy of stability within the market. And the longer interest rates stay high, of course, you're going to shake out the deals that aren't cash flow positive or are cash flow crunched. And there are ways to set yourself up. In this club, we were talking 2 years ago about get into long-term debt. Long-term debt's really the major thing that's going to bring you through long-term fixed rate debt. So that's a good club discussion. There's a lot of data points we can bring right now too. So we'll bring that up soon. All right, with that, Kale, I'm going to turn it over to you. Welcome to the group here. You've got a podcast of your own, don't you? I see it in the background. Why don't you tell us a little bit about yourself, your investing, your podcast, and we'll kick this off. If you've got questions, put them in the chat.
Yeah, and actually, just before we jump into it, I did want to ask you that in terms of the format. Like when people have questions, is it do they chime in, or do you have them put them in the chat, or what's the deal?
Yeah, with 80 or so people here, we usually have them put them in the chat, and then I'll just judiciously interrupt you and bring the question up when it seems like it's an appropriate moment.
Perfect.
And feel free to chat in the group too. It's not only for that. Drop your own email address if you want to connect with somebody.
All right, excellent. And I'll go ahead and share the screen now so we can just get that going here.
That was kind of Gen X of me. Send your TikTok handle.
And oops, I think I shared the wrong screen. Hold on. Hold on. There we go. Okay. All right. Can you guys see that? My screen?
Yes,
Okay.
we can.
All right, perfect. Okie dokie. And you can see the presentation, right? Okay, perfect. All right, excellent. So yeah, thank you guys for having me. Really appreciate the opportunity, Daniel, and look forward to sharing some about short-term rentals with you guys. So we're going to be talking about cash flow and tax saving strategies with short-term rentals. We're going to go through really an overview of a lot of things, the essentials with short-term rentals. And so if anybody has any particular questions as we go throughout, I guess put them in the chat, and we can jump in and chat on those as we want. If there's things you want to spend more time on throughout the presentation, let me know as well. But we're going to give an overview of several different things here and give you guys a real taste of what it's all about. So we'll go through my bio, introduction to short-term rentals, some different investing models, tax benefits and financial advantages, operations, streamlining with systems and software, automation and time efficiency, financing strategies and options, and then any additional Q&A. So for me, who am I, right? Who's Kale Delaney, and why am I here talking to you about short-term rentals? So I'm a Christian, I'm a husband, father of 3 kids. You can see here, this is me and my family. I actually graduated from the University of Miami's College of Engineering with an engineering degree, of course. However, I did not go into engineering. I actually ended up right after college. I worked 2 years as a commercial real estate investment broker down in Miami, Florida, selling multifamily and retail. Great experience, terrible timing, 2006 to 2008. And so as the market dried up, I left that industry and went into construction management. So I ended up working 15 years as ultimately a senior project manager for a large contractor throughout the country. And so I really didn't begin my investing career until 2020. And I had started out in long-term rentals and then transitioned into short-term rentals because my goal at that time was I wanted to replace my income from my current job and do it fast. And long-term rentals was not going to get me there. So in a brief period, about 18 months to 2 years, built up a real estate owned portfolio of over $6 million in short-term rentals primarily. In that time span, we generated over 1.8 million in bookings, hosted over 6,300 guests, including 200 pets. I'm also a best-selling author in Hospitable Host 2, which is a book that was released earlier this year. Host of the Fit Investor podcast, which Daniel mentioned, and you probably saw on the screen behind me. And on that podcast, we talk about how to be fit financially, physically, and faithfully. So again, we're a Christian-based podcast, but we interview entrepreneurs, trying to learn from them and hear from them on how to live a more holistic life in those three areas. And ultimately, I retired, quote unquote, in 2022, so end of last year. And now I focus full time on real estate investing, podcasting, speaking, coaching, and consulting. So that is me in a nutshell. So we'll start out real simple here. What is a short-term rental, right? Short-term rental is specified as a property that's rented out, obviously a short period of time, but usually less than 30 days. And more typically, it's going to be less than 7 days, right? And keep that number in mind, the less than 7 days, because that's going to be important when we get to talking about the tax advantages, right? Can be used as a for personal use as a vacation home or as a full-time investment rental. So it's very flexible in terms of how you want to do it. And to start off, I wanted to touch on a little bit about what the STR landscape looks like today, because if anyone follows, social media or, media in general, you may have heard rumors and things like that swirling around of this quote unquote Airbnb or Airbnb bust, as it was kind of coined, saying that, the sky is falling, short-term rentals no longer work, everybody get out. Frankly, and we'll touch on it a little bit more, but a lot of that was really just media hype and rumors and hate to use the word, but it is what it is, fake news, right? When you actually look at the data, here's what the data says. So demand, and this is all from AirDNA, which is one of the top data resources for the short-term rental industry. So when you look at demand, it's better than anticipated economic fundamentals and unrelenting enthusiasm for travel. It's significantly increased demand growth forecast for 2023 to 10.4% year over year, up from 5.5%. So increasing demand, that's a good thing, right? Supply, increasing mortgage rates and declining occupancy have slowed supply growth since the first half of 2022. The house prices have declined more quickly than anticipated, while demand growth has remained persistently high. So a little bit of a decline on the supply side, but supply is still super strong. And there's a chart that I'm going to show that might help explain that a little bit more. But so we have really strong demand. We have strong supply, but declining a little bit, which actually is a good thing, right? When supply is declining and demand is increasing, that means better performance. Occupancy, strong supply growth may create a second year of declining occupancy. The decline is not quite as steep as previously forecasted, though. Ultimately, it's projecting an average of 57.6% occupancy, with 2024 seeing a little bit of a slight decline to 56.7, but it's still significantly higher than pre-pandemic levels. And that's another key thing to keep in mind. And I'll just preface that because 2021 and 2022, the pandemic years, so to speak, is really when this boom in the short-term rental industry, kicked off, and it really started becoming popular in media and social media and just popular culture. And those 2 years were a bit anomalous. So, I tell people really don't even look at 2021 and 2022 when you're looking at data points. Those years are probably never going to be repeated in terms of their performance. It was a very easy industry in those couple of years, right? You really could buy almost any property, not really do anything, and make some money. It's not quite that way anymore. You actually have to put in some work, and we'll talk about that. But all that to say is that filtering out those kind of anomalous years, as the data shows, occupancy levels are still projected to be increasing over those pre-pandemic years, which is important. Average daily rates, or ADRs. Economic uncertainty, persistent inflation have led the consumer to search out value. So ultimately, better than expected economic conditions have increased the forecast actually to 2.1% year over year. So increasing rates, another good thing. Revenue per available rental, or RevPAR. The small improvement to ADR and occupancy don't quite add up to RevPAR growth in 2023, but the forecast is still somewhat higher at negative 1.1%. So ultimately what that's saying is that all of this stuff together, what it really means is revenue is more or less on par or slightly below minus 1% from 2022, which frankly, that's huge. I mean, that's still excellent. 2022 was a record year. So to have 2023 revenue averaging out to be on par almost with that is pretty tremendous. And frankly, in my portfolio, we're actually up revenue year over year from 2022. This, of course, is national data averages. So it's going to be regional and market specific. But overall, to have revenue be more or less on par with a record year of 2022 is pretty phenomenal. And so here you can kind of see that just spelled out in the numbers, right? And you can see 2021, 2022, 2023, even these tremendous jumps in supply, which is as available listings and nights listed percent change. Those are really your supply numbers, right? See these huge jumps, especially 2022. Look at that, almost 25% increase in supply. All right. You had an 18% increase in demand though still. Your occupancy rates. So you can see pre-pandemic 54.9, 54.8. Now we're 57.6. So still trending in the upward direction. 2021 and 2022 were a bit of those anomalous years. So again, overall, all this to say, and not to bore it too much with the data, all this to say that the Airbnb bust is not accurate. So that's kind of where it all started, with this tweet, really, of all things, that spread like wildfire and just created all these rumors and all these things. But here it is, straight from the vice president of AirDNA. The idea that the short-term rental industry is seeing any kind of demand bust is laughable. A lot of new hosts were reacting to seasonality trends in the market that they weren't aware of. Yes, occupancies are coming down as the industry expected, but we're still at high occupancy overall. So that's just what the data that we went over. And that's really where this came from. You had a lot of people that jumped into this industry in the past, 2-3 years that frankly did not jump into it to treat it as a professional business. They jumped in perhaps as a hobby, or they jumped in with the anticipation that they could do nothing and still perform well, or they got caught up in the hype of the market and way overpaid for their properties. And now they're feeling that pain, right? So those are the people who are having challenges right now. People who either did not buy right or are not managing right. But if you purchase right and you manage right in this market, all the data points say you're going to do just fine. And, I'll tell you from my personal experience, again, things are working out just fine this year. And I expect it to be the same. So what are the benefits of short-term rentals? The high cash flow potential. That's really what draws most people to them, right? In terms of real estate and, a lot of alternative investments in general, it's hard to match the cash flow potential that short-term rentals really have. Especially when you compare it to long-term rentals. The flexibility that it offers to use it personally or as an investment, that's important to a lot of people. The tax advantages, that's the other big one, and we're gonna really hit on that in a little bit here, because I'm sure that's important for a lot of you guys. So the excellent tax advantages depending on the ownership model, especially for high-income W-2 or 1099 earners. You can manage it from anywhere in the world with Wi-Fi and a phone connection, which that was something that was really important for me when I got into it as well, is I wanted something that could be location independent. You can automate 90% of the business through software. The beauty of technology today. And of course, it's just another excellent diversification option. So what are some ways to invest in short-term rentals, right? Same with most other real estate, straightforward, the ownership model. And that's the model that I promote the most. That's my business model, primarily, is the ownership model, because it has the most advantages, right? Of course, you have appreciation and equity. You have the ability to pull out cash and reinvest. You have significant tax advantages. The downside is it's capital intensive, right? So you're going to have that down payment, those closing costs. So that's the downside of it. Co-hosting. So this is becoming more and more popular, especially in today's market. And I do this model as well for additional income streams. But this is basically where you are managing somebody else's property for them. So essentially think of it as property management, right, for short-term rentals. This is really popular now because it's becoming harder in this market to find good deals to purchase. So if you can't find a property to purchase yourself, then perhaps it makes sense to manage a property for somebody else. And you can make, very, very good money doing that as well. Very high profit margins doing co-hosting. And it's the least risk and out-of-pocket expense, right? Your out-of-pocket expense basically is set up an LLC if you don't already have one, get some insurance, and that's about it, right? The rest is putting in some legwork to get clients. And the risk is, again, very, very minimal. If the property doesn't make money or is not profitable, you're still making money. Of course, you want the property to be profitable for the owner as well. Otherwise, you're probably not going to have a client. But as far as money coming out of your pocket, there's very little risk on that. It does obviously require the knowledge and expertise to get the clients and manage it properly. And of course, has minimal tax benefits, right? You're not going to get the big tax benefit that we're going to be talking about here with the ownership model. Another popular one is arbitrage. Personally, I don't promote this one. It certainly has its place, and it certainly can be a great option for cash flow, but that's really what it is. It's purely a cash flow play. There's low to moderate out-of-pocket expenses. You are going to probably be having to pay out of pocket to furnish the property. And this is basically where you rent a property from somebody else on a long-term lease, and you turn around and re-rent it as a short-term rental, right? So you're doing that arbitrage of what you make as a short-term rental and what you pay as a long-term rental. So it can be very profitable, and that's why people do it. But it is the highest risk, right? If it's not performing, you still have that lease payment to pay, right? And the furniture, if it doesn't work out, what are you going to do with the furniture after? So you have all that out of pocket. And again, the lease tax benefits. So again, the ones that I focus on, ownership, I think that one is the best way to go. That's how you actually build wealth. That's how you're going to get the big tax advantages. If you're looking for, a more cash flow play, that's not capital intensive, co-hosting is a great way to start to get into the game and perhaps build up some cash flow to be able to start purchasing, or do a combination of both, like I do right now.
Kale, we've got a couple of questions that I could probably throw your way at this point. And quite a few of them actually revolve around, well, actually the first one, and this might be a little more in depth. Let me jump to the second one, actually. Tao is asking, does the into market time matter? We have a property wanting to transfer that we want to transfer to Airbnb by the end of the month. Is it not a good time for us?
I think it's a great time. I mean, you want to look at the market you're in and the seasonality of your market. All right. So, and not to say that you can't go live with a property during slow season. There's actually some benefits to doing that. So yeah, you just want to look at your market, see where it is in the seasonality cycle. Are you going to be launching it into slow season or high season, and just get prepared in that manner? But yeah, I would see no reason to not get it going if short-term rentals is something that you want to pursue.
And then as a follow-up to that question, I'll jump back up to Glenn's question, which was first. He's asking more about what data points do you use in order to really do your, I'll call it underwriting, even though he doesn't use that word. Here's his question. Maybe you'll get into it, but I'm wondering what your opinion is about occupancy, about the levels of occupancy, RevPAR, ADR, etc. How should they be used when evaluating a property purchase?
Sure. I'll touch on it very briefly right now, just because we are going to get into it more later.
Well, we can save it if you're going to.
Yeah, okay, yeah, let's just
Yeah,
save it,
yeah.
because we're gonna get into
Okay. And then one question about co-hosting. In co-hosting, do you split the revenue with the owner, or is it a fixed amount like property management?
Yeah, so typically it's done on a commission-based model, so a percentage of gross revenues. And typically you're gonna see 20 to 25% of gross revenue that you charge as a co-host.
How is that different than property management then? Is it a property management model?
It ultimately is a property management model. Depending on where you are doing it, there may or may not be reasons why you do not want to qualify it as property management for tax purposes and licensing purposes. So that's just something to be aware of and look at when you're, depending on where you're looking to do it. But in general, yes, it is ultimately property management. Co-hosting is more or less the terminology that's been coined for the short-term rental industry, where it's not like a big property management company. It's more so a boutique operator, like myself, who would be managing it.
Okay. Let's continue on with the talk.
Perfect. So I want to throw these in here, just a couple ownership model case studies. So these are case studies from my portfolio, just to show you guys some of the potential and the power of this. So this was actually my first short-term rental. So this was a cabin purchased in the Smoky Mountains in Tennessee. Purchased it as a 4-bedroom, quite large, 3,000 square foot cabin in 2021 for $650,000. This was listed for $700,000. And again, this was 2021. So at this time, the market was on fire. I mean, it was, especially in this market, the Smoky Mountains, if you're not familiar with it, is the top vacation rental market in the country. And it has been for years and years and years and years. And so especially in this market, it was on fire. I mean, properties were coming on the market, and within 48, 72 hours, you'd have a dozen offers, and it would be sold for 20, 30% above asking price. It was pretty nuts. And I was able to, get this one under list value, which was unheard of in this market, using what I call the stale listing strategy. But anyway, it's 4-bedroom. I did some minor renovations, spent about $15,000 in converting a 2-car garage into an additional bedroom and a theater room. I also converted what was actually just a humongous separate walk-in closet into a bunk room, meaning, with bunk beds. So I essentially converted it into a 6-bedroom cabin now with a theater room for a total of 3,400 square feet livable space, and generates about $150,000 in gross revenue annually. And it appraised in February of this year for $1.15 million. So very minimal adjustments, but smart adjustments, and turning it from a 4-bedroom to a 6-bedroom, which is going to be key in the short-term rental industry. Is the more bedrooms you can have, the more people you can sleep. That's really one of the keys to your revenue. So, I mean, a $500,000 gain in 2 years, plus the obviously the revenue it was generating during that time. Another case study here. So this one was actually a small studio cabin, 600 square feet, purchased January of 2022. Purchased this one for $317,500. We purchased this all cash. And again, using my stale listing strategy, we got it under or below asking. No renovations on this one. Just, whatever maintenance it needed and cosmetic updates and furnishing. It generates approximately $55,000 gross annually. We refinanced this 6 months later in August of 2022, and it appraised for $425,000. And so we pulled out $297,500. So basically in 6 months, $107,000 gain in equity and only $20,000 left in the deal. So I mean, this again, this is why I love the ownership model, because with those other models, you can make some good cash flow, but you're not going to make big gains in your equity and appreciation like this, right? Okay, tax benefits. So this is the good stuff here. if you guys are familiar with, Robert Kiyosaki, I'm sure Rich Dad Poor Dad, his CPA, you may have heard of him, but Tom Wheelwright, really great guy to follow. He has an excellent book called Tax-Free Wealth. If you haven't read it, I highly suggest you read it. Really good information. But what I love about him is his outlook on taxes is the opposite of what most people think, right? Most people think of taxes as a penalty. Well, what Tom Wheelwright likes to say is, no, it's not really. Actually, it's simply a series of incentives, not penalties, but incentives to do what the government wants you to do. If you do what the government wants you to do, you pay less, you pay less taxes. Very simple. And rental real estate investments not only shelter cash flow from the real estate, but can also shelter other income from taxes. And that's what we're gonna talk about here. So yeah, that's why real estate in general is so powerful, because of all the tax benefits, and then short-term rentals on top of that, because of this one particular quote unquote short-term rental loophole that allows you to offset active income with losses from your short-term rental operations, which is huge. So of course, running it as a business, and as real estate, you get standard property and business deductions, right? Your mortgage, interest, and insurance, property related expenses, tax deductible work trips / vacations. If you do it right, you need to do necessary, or has to be necessary and ordinary expenses to be able to qualify that vacation or trip, to be able to deduct it. I listed some of those necessary and ordinary activities, but most commonly repairs and maintenance. So, if you visit your property and you're performing legitimate repairs and maintenance, there's a good chance that you'll be able to write off the expenses of that trip as well. So again, that's another reason why, people like short-term rentals, especially if it's in a place you like to visit. The good stuff though, the golden ticket, the STR tax loophole. So this is where it defines short-term rental income and losses as non-passive. And that's what's key, because regular, other types of real estate, long-term rentals, commercial properties, those are considered passive. So your losses can only offset other passive income, meaning, other income from real estate or other passive ventures that you have. But your W-2 income, your 1099 income, it doesn't do anything against up to certain, small limits. However, short-term rentals is classified as non-passive. So your losses, your paper losses, can be used to offset your other non-passive income. Very important. So it has several requirements. Like I said, keep that 7 days in mind, because here's where it comes into play. It has to be an average stay of 7 days or less. In general, that's not going to be a problem. Short-term rentals, typically you're probably actually going to be more averaging of 3 days, for your general stay. So meeting that is pretty much a no-brainer. The other one is you have to meet one of 7 material participation criteria. The most common 3 that people try to hit are spend more than 500 hours on the STR business, do substantially everything for the STR business, or spend more than 100 hours on the activity, and no other individual spends more time than you do. So the reason this is important as well is because, I mentioned that other real estate assets, you can't offset your non-passive income. I should say there is a way you can, but you have to qualify for what's called a real estate professional status with the IRS, which if you have a W-2, is pretty much impossible, because it basically says you have to spend 750 hours and it has to be more than anything else you do. So to say that you spend 750 hours on your full-time job, and then you spend another 751 hours on your real estate, does not really pass muster, right? So with short-term rentals though, you can get away with, you only have to spend 100 hours on the activity, and it doesn't have to be more than anything else you do. So you can work a full-time job and you can easily spend 100 hours on a short-term rental, even if it's only 1 or 2 properties. If you're self-managing it, you're going to pretty easily hit that qualification, right? So This is why it's so popular and short-term rentals are so popular when it comes to taxes, especially with high income earners, W-2 and 1099, because it's very easy to hit the requirements to be able to utilize those losses. And so what are some examples? How does it actually play out, right? So again, the goal is to offset your non-passive income. How do you do this? Through what are called cost segregations and bonus depreciation. So when you depreciate a property normally, depending on if it's residential or commercial, for short-term rentals, they're classified as commercial actually. So they're depreciated over a 39-year lifespan. So instead of doing a linear depreciation over 39 years, a cost segregation breaks the building up into its different components and depreciates it in those different lifespans. So, it'll pull out your 5-year, your 15-year life items. And what this does at the end of the day is essentially kind of the rule of thumb, not guaranteed, but a good baseline is that you can typically expect about 20% of the purchase price of the property to be able to receive as what is called the bonus depreciation that you can use in year one. So as an example, if you purchased a $1 million property, you did a cost segregation, like I said, expect anywhere between 20 to 30. So I just did an average there. So expect around $250,000 of a deduction that you could take against other active income. So if you had a W-2 that you're making $250,000 for, this would essentially wipe out your income, right? So, and again, just using a moderate 24% tax bracket, that would essentially translate to $48,000 cash in your pocket that you would not be paying in taxes. And it's 48,000 because, and the next slide will show it, but starting in 2023, at least the way things are now, unless things change, but right now it's scheduled that every year it's going to decline by 20% as to the amount that you're going to be able to take. So last year you could use that full 250,000, 100%. This year you can only use 80% of that. Next year it's going to be 60%, 40, 20. So that's where it is now. So all the more reason to, get started as soon as you can.
Hey, Kale.
Yes.
We have an active group here in the chat. You mind if I throw a few questions your way now?
Yeah, absolutely.
All right. So Ashish is asking, when buying new STRs, how do you factor in that property prices are at near an all-time high? How do potential falling prices impact your business plan?
Yeah. So like I said in the beginning, you have to purchase right. So no matter where the market is, you have to run your numbers, and we'll get into the underwriting a little bit in a little bit here. No, actually, yeah, it's in the next section here that we're going to talk about. So when you're underwriting, I mean, you're just going to make sure the numbers work for your criteria, right? You can't look necessarily at, well, it looks like the market's at a peak here, because that's what everybody was saying. Shoot, that's what everybody says almost every year, right? The market is at its peak. Nobody knows. Nobody knows. It all comes down to, do the numbers work or not for your criteria, right? That's really what it boils down to.
I'd add to that, and this kind of follows up on Kaustub's question. He's asking, is the appraisal based on revenue? And go ahead and answer that question, and then I'll give my comment.
Yes and no. Technically, no. However, where you're purchasing the property is going to matter. So if you are in a definitive established short-term rental market, like for example, the Smokies or Panama City Beach, Florida, Gulf Shores, Alabama, any of these really popular vacation rental markets where a vast majority of the transactions are investment properties, the appraisers are they're not going to be looking necessarily at income, but of course they're going to be looking at comparable sales, and they understand that it's investment properties, right? So they're going to appraise for a higher value than if they were being sold as strictly a residential property. If you are in a market that is not an established vacation rental market, and you're looking at paying a premium because it's an operating short-term rental or something like that, that's where you could potentially run into issues with appraisals not coming up. Though, again, the flip side of it is that if you are in a market that's not truly established and things are still selling more as residential transaction than investment transactions, chances are the purchase prices are not going to be quite as high either. So yeah, so technically, no, they do not base it off income. But if you are in a market where the transactions are primarily investment property transactions, they're going to factor that in, and your appraisals are not going to be an issue.
So the comment that I was going to throw in there is that your lending is going to have a lot to do with this, because as Kale mentioned, this is a residential property. Properties that have 4 or less units are residential, and 5 and up are generally considered commercial.
Right.
And so when you go to the lender, they're going to be evaluating this from the point of view of a residential property, even if they know you're using it as an investment.
Correct.
And so they'll actually try to come to you with a loan, an investor's loan. And oftentimes banks want 25% down on an investor's loan, whereas it might be just 20% down on a personal property or other type of property. So the bank is definitely going to operate from the point of view of residential, and your appraisal is going to be based on the comparable method of appraisals. What are the other properties around it like, rather
Right.
than its income?
Yeah, and to tag on to that as well, and is why it's so important to work with a short-term rental specific lender. You don't just want to work with any lender with short-term rentals. You need to work with a short-term rental specific one that knows what they're doing. They're going to have the connections with the appraisers that are going to do it right. They're going to be able to guide you through it. There's been, trust me, I've heard so many horror stories of people who try to use a regular lender, go to a big bank and try to get it as a short-term rental, and it doesn't pan out. So yeah, make sure you use a short-term rental specific lender. There is also, and it's a little bit later on, but there is also the options of doing what's called a DSCR, or debt service coverage ratio, which is technically a commercial loan product. But that does actually value or underwrite the property from the lender based on the income. So they will actually utilize the estimated income as a short-term rental to underwrite the property and determine if they'll lend on it or not. So there's that option that you can have as well.
Thinking here too, if you happen to have a portfolio of properties and they were aggregated together,
Yep.
maybe in a series LLC or some other type of grouping entity, you could probably sell them based off the income as a group portfolio as well.
Right.
So the most popular question in the chat right now, everybody wants to know more about your stale listing strategy. What is that?
Yeah, it's pretty simple. So you'd think it wouldn't work, but it still works today, and it still worked in a super hot market. Ultimately, what it is looking for what people are missing, right? So looking for properties that have sat on the market a little bit longer than the normal. Maybe a property that has bad photos, right? Maybe it just the listing is crap, right? And looking at those and looking for opportunities. When the market was super hot, like I was saying, things within 48 to 72 hours, things were sold way above asking. And the way it kind of worked was that if something did not sell within the first week, there was so much inventory coming online that it just got pushed to the wayside and almost got forgotten about, right? And a lot of people would just pass it by because they think, well, there must be something wrong with it. That's why it didn't sell, and not even look at it. So I took the opportunity because I refused to get caught up in the bidding wars that were happening and paying way over asking, which again, I go back to buy right? That's the first step, buy right, stick to your criteria. And so that's where I looked for, how can I compete in the hottest market in the country in a time where the market's on fire and still pay a reasonable amount, right? And that's how I was able to do it. So looking for kind of diamonds in the rough, properties that have sat on the market a little bit, maybe the listings don't look good, maybe the photos don't look good, something that other people are going to pass by. And that's honestly, I've used that for every single property that I purchased, and I've gotten every single property below asking, and they perform excellent.
So Kale, just for your reference, we've got 14 minutes to the end of the meeting. And I'm going to give you one more question here before you continue on. Brooke is asking, so if you hire somebody else to manage an STR, would it fall under the passive income category? So I assume he's talking about qualification number 3, where you have to be, it's 100 hours and more than anybody else is managing it. Do your property managers count for that? Do your cleaners count for that?
Yes, very good. I'm glad actually you brought that question up. That's a very good point. So to meet that qualification, you probably are going to need to self-manage the property. Once you have a larger portfolio and maybe you can look towards the 500-hour requirement, you might be able to get past that, but you're going to most likely need to self-manage the property to meet those qualifications and be able to utilize that tax benefit to its fullest potential.
And Ryan has a question about cost segregation, and maybe I'll just quickly answer it. You can cost segregate a house at any point. So if you've owned it for a few years and you're converting it over, you can still do a cost segregation at that point. And in fact, CPAs will even backdate your cost segregation. So if you want to refile previous tax years, you can run a cost segregation now and then retroactively apply that back a certain number of years. I think Mark Prolberg in our group talked about that. All right, we've got a number of other questions, but I know you've got a lot in your talk left, so I'll let you go.
Yeah, sorry, and I'll try to speed these up here a little bit here. Someone had asked about the underwriting and what metrics do you use for analyzing a deal. So we'll jump on that here. So cash flow analysis and cash on cash. So estimating revenue and expenses, right? That's going to be critical. Again, repeating it so many times because it's so important. Buy right, underwrite properly, be conservative, right? According to your risk profile, I'm a pretty conservative investor, so I underwrite things very conservatively, which makes a lot of deals not make sense and makes me need to be a bit more patient, but I'm fine with that because I'd rather not risk it on overpaying. So be conservative. Utilize a knowledgeable STR focused real estate agent. Just like why it's so important to use an STR lender, you need to use an STR focused real estate agent. This is critical. You need to be working with somebody who knows the STR industry, who knows that market, because they're going to really be your baseline in terms of helping you understand the market, regulations, your income and expenses. Like I can't stress that more than, especially if you're newer. Find a good short-term rental realtor. Tap into the STR community. So there's tons and tons of Facebook groups about this. I'm big or heavily involved in those. Those are excellent sounding boards, excellent ways to network, excellent ways to build your community and learn and grow in the short-term rental industry. There's data resources. I mentioned AirDNA previously, a couple others, Rabu, Mashvisor. Very simple. You can plug in an address and the number of bedrooms, and it'll spit out an estimated revenue potential. Take those with a grain of salt. Please do not take them as gospel. You need to do your due diligence. You need to, talk with your realtor. You need to look at, go into Airbnb, look at other properties in that area and see what things are actually renting out, what the occupancy looks like. But those data sources, those estimates are pretty good baselines, I say, if you're looking to just a quick number. Don't forget cleaning fees. This is something that, man, so many people when they're new miss in their underwriting and their expenses. You have to put in your cleaning fees, and that's one of your biggest fees. A lot of people assume that, well, since the guest pays it, I don't need to expense it. Yes, you do, because that estimate, that revenue estimate includes the revenue from the cleaning as well. So you got to make sure it's in your expenses. I've seen a lot of people miss that, and man, that'll blow you up real quick. Calculating cash on cash. So cash on cash is the metric that most people use in the short-term rental industry to decide if a deal makes sense or not. Ultimately, it's more or less return on investment is what it is. So you're dividing your net cash flow by the total cash invested, right? So if you purchase a property, the total down payment and closing costs are $100,000. Your net income, meaning after debt service, is $20,000. That's a 20% cash on cash return. So pretty darn good return. To be a true cash on cash return, technically, it should include rehab or update costs. You just got to be aware that can skew your year one cash on cash numbers. pretty heavily, right? To the downside. So just take that in consideration and look at your pro forma year 2, year 3 cash on cash returns as well, right? It may be okay to have a really low year 1 because of rehab, because year 2, 3 and beyond, it's going to be really nice. So that's just a personal consideration to look at. And everybody's criteria is different, right? Some people might stick to 20% cash on cash return. If it's below that, I don't want it. Somebody else might say 10 is fine. Somebody else might say 0 is fine. I'm okay with breaking even because I just need some tax benefits, right? So what works for me may not work for you, right? So don't get stuck on anybody else's criteria. Figure out what your investment criteria is. And when you figure that out, stick to it. Again, don't get caught up in bidding wars. Don't get caught up in hype. Don't get caught up in overpaying. Don't force numbers to work. Let them make sure they work. Stick to your criteria. Yeah, real quick, local or remote, doesn't matter. No, the process is the same if it's across the street or 1,000 miles away, right? If a pipe breaks, are you going to go over there and fix it yourself? Probably not. You're going to call a plumber. So you can do the same thing 1,000 miles away. I prefer remote investing, frankly. I think it forces you to build out your team and systems, and it gives you the freedom to manage it, like I said, from anywhere in the world. And it opens you up to better markets too. Like a lot of people get handcuffed to thinking they have to invest in their local market, and it may not be the best market to invest in. Operations. I'm gonna skip over a lot of this here, but just a couple highlights. Especially in today's market, you need to make the property nice, right? You can't just throw anything up like I mentioned you could do a couple of years ago. You got to have a property that looks nice. The more you can do to stand out, the better you're going to perform in this market. Photography, that is your #1 investment with your property. You want the best photos you can get because that's what people see. That's what stops people when they're scrolling through Airbnb. That's what stops them to click on your listing and hopefully book it. So do not skimp on photos. Do not find the cheapest photographer you can get. Find the best photographer you can get. I'm going to skip that for now. Systems and software. So 2 key pieces of software that you're going to need. What's called your PMS or property management software. This is what is essentially the hub, right? So this is what's going to connect all your different platforms, your Airbnb, Verbo, Booking.com, whatever platforms you're using. It's going to sync all the calendars. It's going to provide you with a unified inbox so that you don't need to be logging into all the different accounts to respond to things. You can just do it from this one software. And they're all mobile friendly. So, very easy to do from your phone as well as your desktop. I listed some popular ones here. They each have some benefits and disadvantages. But that's going to be one of your primary pieces of tech that's going to make your life a heck of a lot easier. And I'll just jump back. The automation part too, the other thing they do, automated messaging. So that's where you can set up 90% of your messages ahead of time so that they go out automatically so that you're not having to redo that. And that's where streamlining becomes really important. The next big piece of tech is going to be your dynamic pricing software. So what this does is this scrapes data and is going to ultimately, based on parameters that you set, is going to adjust the pricing on a daily basis. So this is going to take into account supply and demand, holidays, compression events, all that stuff. This is crucial. If you don't use a dynamic pricing tool, you are missing out. There's some popular ones there that I mentioned or are listed in there. I'll probably skip this here. Housekeeping and maintenance, really the biggest thing you got to know on this is find a good boots on the ground team, right? Your cleaner, your handyman, maintenance team, and your trade vendors, right? Find those teams. Great way to find them. Join those Facebook communities, get referrals. But that's going to be super critical. If you don't have a good cleaner or a good handyman, your business is down the drain. I'll skip that. VAs, again, to get things more passive, eventually VAs are a great option. We don't need to go further into that. Financing we touched on earlier, and I'll stick on this for just a minute. So a popular thing that people do in a new market, outside of where you live and outside of where you own other properties, under meeting certain criteria, you can get typically a second home loan on the first property that you purchase out there. A second home loan does have requirements for some personal use, but it does allow it to be rented out as well. So this is a popular technique for people to get in with 10% down. That's the biggest benefit that it offers, is you can get into 10% down on that first property in a new market. Of course, talk with your lender, make sure you're meeting the proper qualifications to be able to do that. Otherwise, the conventional investment loans are going to be 15 to 20%. So I used the second home loan on that first property. The rest, since they're all in the same area, I've done conventional investment loans at 15% down. DSCR loans, I mentioned those previously. That's actually a commercial loan product, and that does not actually look at your income for qualification. That only looks at the income of the property. And you can get in with, it used to be just 20%. Just in the past month or so, actually, I've seen some are now offering 15% down options. They are higher rates and they have prepayment penalties. So, you know, they're not a last resort. I mean, the good thing about them is that they don't come up on or they don't affect your debt to income ratio, right? Because that's what happens a lot is you start buying a lot of these under conventional terms, you start using up your debt to income ratio, and then you get to a point where you can't purchase anymore conventionally. So your only other option, or one of the other options, is your DSCR. Of course, there's creative financing, sub-2 seller financing, all that stuff. Yeah, okay, good. So key takeaways. Ownership model provides the most benefits, but is capital intensive. Co-hosting provides the least risk and good cash flow, but minimal tax advantages. The golden ticket of cost segregations and bonus depreciation, and using those paper losses to offset active income. Market analysis and guest experience are crucial. Can automate 90% of the business with the proper tech stack of a PMS and dynamic pricing software. The importance of having a trusted boots on the ground team, and utilizing various forms of financing to best leverage your investment. And there's some like contact information and all that stuff. If you scan the QR code, it'll actually have all those links in that one spot as well. And you know, we only have a couple minutes, so
yeah, well, let's hit you with rapid fire, a couple of questions here. Yeah. First of all, and try to, I guess, keep this short because it could be a whole topic, but what's your strategy for furnishing a house?
It depends. I mean, Amazon's great. There are some great companies out there that offer subscription services where you get access to significant discounts. So if you are furnishing a lot or several properties, those are going to be your best bet. Because yeah, you can typically get 20 to 30% off what you would pay retail. So it's kind of like a wholesale membership, more or less. Again, in today's market, the importance of interior design is becoming more and more important. So having good design, even hiring an interior designer to select your furnishings is becoming more popular and more important.
Hey, for everybody that's in the group here, congratulations. We maxed out the Zoom account. So if you need to find the rerun, it can be found at alternativeinvestingclub.com/speakers hall of fame. My apologies to anybody who got shut out. I got a couple of emails saying that people weren't able to get in. Kale, how do you find an STR focused real estate agent?
Yes. Again, the communities, I would suggest people, if you go to biggerpockets.com, honestly, that's probably going to be one of the best ways to find. They actually have a tab. You can just search up realtors for short-term rentals, but getting involved in those short-term rental communities on Facebook as well, and just asking in those groups, you know, based on what market you're looking at, who are the top short-term rental realtors, and trust me, they'll let you know who they are.
Sorry about that alarm, everyone. Let's see. I lost my train of thought here. What property management software do you use?
I use Hospitable.
You use Hospitable. Okay. And I guess finally, we're at the top of the hour. Could everybody here take themselves off mute and thank Kale for coming in and talking to us today?
Thank you.
Thanks, Kale.
Thank
you, Kale.
Yeah, thank you. That was really good.
Thank you.
Thank you, Kale.
Thanks, Kale.
Very
Great
welcome.
job.
Thank you.
Thanks,
Thanks,
Kale. This is really great information you put it in the slides. Thank you so much.
You're welcome. Thank
you, Kale.
Everybody, make sure to check out his podcast. It's The Fit Investor. Is that
Correct.
correct?
Yep.
Correct. Okay. And thank you, Kale, for being here. Have a great weekend, everybody. We'll see you all back here next week, Friday at noon Pacific time. Same bat time, same bat channel.
Thank you, guys.
Hey, Kale.
Yeah.
Can I jump on like a 5-minute call with you really
Yeah.
quickly after this? Okay.
Yeah, no problem.
I'll send it to you via email.
Okay. All right, cool.